This chapter, Chapter 7, concludes our study of financial markets by now taking our understanding of what the interest rate is and how we can understand it as changing based on investor preferences, perceptions of default risk, varying levels of liquidity, taking that all one more step to say then how do we understand the value of things in the marketplace? And so here we're shifting a little bit away from the bond market and a little bit more towards how do you properly value something in the equities market, meaning the stock market. And so in general, we do this with the efficient market hypothesis. And the efficient market hypothesis basically says that people make decisions based on all available information. And if everyone is operating based on the best available information and sometimes willing to pay for that information, then the market itself should be efficiently priced, meaning that there shouldn't be any wide variations in prices that change that are different from what the reality is, which basically means that there's not a lot of hidden opportunities that are out there in the marketplace. So, to do this, as we now look at the equities market for the first time, really in this course, we're going to look at how do we calculate the price of a common stock, of an equity. And then what impact does new information have on these stock prices? Then, how do we compare rational expectations, which means that I'm operating on all available information? How do I contrast that with adaptive expectations, where basically I'm making decisions based on past experiences? And finally, concluding with the fact that despite the fact that there are opportunities out there to make money in the stock market engaged in what we could call arbitrage, meaning prices different than the reality, why that would still imply that the efficient market hypothesis is holding. Okay. So let's talk about how do we value a stock. Now this in itself is actually entire courses. You can take a degree at Manoa in finance. You can work with Ben Bystrom and basically spend semesters properly valuing stocks. It would make you a financial analyst, basically. We're just going to do a very simple discussion here and not make it equation based, only because this is an economics course, not a finance course. And one simple way to calculate the price of a common stock would be with the 1-period valuation model. And so we're doing this to say, what is the inherent value or the intrinsic value of the stock? Not necessarily what is the market saying it is, but what is its true value? And here all we do, if we're trying to compute it with the 1-period valuation model, we look at what all the cash flows are and discount those to the present value. And so we're doing that here because the cash flow is the dividend. And the price would be what I can sell it at in the future. And then I discount it, and there's my discount factor. With my 1 over my denominator of 1 plus KE. And so I discount the cash flows, the dividend, and the future stock price, and come up with a valuation. In another model of getting, again, the true value, the mathematical value of what the stock should be, we could look at the dividend valuation model. So long as that stock is actually paying a dividend. And here what we do, instead of looking at all forms of cash flow as we did in the previous model, we're looking at all dividends for all time periods. The further out in time we go, the less of an effect it has on price because it's going to be so heavily discounted. And so, as the last line in this slide implies, is that the inherent price of the stock then is going to be determined by the present value of all the future dividends. So that gives you, a slightly different way of seeing this. And then we have the Gordon growth model. It's a type of dividend discount model, but now we're going to say that the dividends are going to grow over time. So now we're going to have to make a further assumption about what the growth rate is going to be in the dividend. And if we say that the dividends are going to continue growing at some constant rate, then we could discount those cash flows and determine the implicit value of the stock. That mathematical computation of the inherent value of the stock is going to be different from how the market determines the price. Because, like it or dislike it, if you listen to my investing video, the optional video that I had made, I was expressing frustration with the price of GameStop because largely the inherent value, the intrinsic value of that stock is nowhere near what the market price is. And so really, far be it from me I don't have enough money to question the market and why it values things the way that it does. The market simply overvalues some things and it undervalues other. It always has and it always will. I mean, take a stock like John Deere. John Deere, ticker symbol DE, makes farm implements, tractors, stuff like that. And it makes like lawnmowers for fancy people. It's based in the mainland. It's based in the Quad Cities, Iowa, Illinois area. And it seems to be always undervalued. Always. Well, I haven't looked at it lately here, so let's just see if what I'm thinking is correct here. Ticker symbol DE. Now, the nice thing about using something like Yahoo Finance is I can look at what the fair value is and the 1-year target estimate. $410. Geez, okay, well, I haven't really kept up on this that much, I guess, then. Well, since the pandemic. Took a really... No, another one. Let's see here. Let's look at Caterpillar. CAT. Also makes large farm equipment and mining equipment and bulldozers, things like that. Not going anywhere. And yet we know that the president right now is, for instance, pushing this big infrastructure deal. Caterpillar makes a lot of things in a monopoly structure where they have no competitors, at least domestically. Komatsu, the Japanese company, is their other big competitor. And yet the stock is going nowhere. $240 a share a year from now? It's a few percent, basically. And yet, when we look at a stock like this, we can complain about why is the market paying so little for a stock that generates growth and generates a 2% dividend, about $4.50. But in some sense, the market is what it is. And it can be based on rumors, it can be based on manipulation within the market, hopefully not that much of that. But the market will price it what it wants to price it at. So, market participants, investors, aren't simply doing the math that I myself do when I'm investing in a stock. But one thing that all people should do is they should try to collect as much information as possible. And then as they receive that information, alter their expectations of what the future price is going to be. You shouldn't just buy a stock because you've heard of the company. You have to truly believe what they're doing will generate growth over time. And if you cease to have that belief, then you should get out of that stock. So let me give you an example of this. I own shares of Lockheed Martin. They essentially make warplanes and implements of war. I am of the general belief that wars happen. They seem to happen a lot. And they're not going out of fashion anytime soon. So it's probably a good idea from an investor's point of view to be invested in something like that. Same with if you bought something like Oshkosh Truck, ticker symbol OSK. Right? It's a stock that war is not going out of business anytime soon. So, if the companies, those two companies, Oshkosh and Lockheed Martin, decided to stop building implements of war and start building something different, that new piece of information would set up an entirely new set of expectations and then alter the value of what I'd be willing to pay for that stock. Now, I wanted to just skip these applications. They're important, but they're not really critical here. Instead of taking in all information to predict the future, one thing we could do, which is a little bit more like part of how many of us can make a simple decision, is just by looking at what's happened in the past. So that would be an adaptive expectation. I just look at what's happened to me in the past and then I make a decision. I change my expectations as basically things happen. Because the thing is that I know with certainty what has happened in the past because it's already happened. Now, sometimes expectations change and the unexpected happens. But this is in terms of cost of acquiring information, this is a pretty cheap way to acquire information. You just have to look at what's happened. As opposed to rational expectations, where I'm taking in all information, regardless of the time perspective, and then sorting through all that information to then make to form an expectation about what the stock price is going to be. In general, adaptive expectations are cheaper to acquire, and so they're used a little bit more often than rational expectations, only because it's difficult at an affordable cost to acquire all the information out there. And adaptive expectations are in some sense good enough. And so to the extent that our expectations are that we have enough information. If we have enough information, then our expectations about what's being forecast should be equal to what we forecast using all available information. That we're basically getting close to making good predictions because we just know everything. And that is, in essence, where we would start to then see that the capital markets, more specifically the equity markets, are operating efficiently. Because basically everyone's expectations are formed correctly. The problems that emerge is that you can make forecasting errors, right? Because if you just follow a trend line that you draw, a log linear line, you could be forecasting presumed growth when it's not going to be the case. If we look at this in terms of is the market still operating efficiently? It is if we can break the habit of saying something has worked in the past, so therefore it must work in the future. That's not exactly what we're saying with rational expectations, because we are taking in so many other forms of information at the same time. And that's what we're seeing here. That if we apply the efficient market hypothesis to the financial markets, then the actual rate of return, R, should equal, based on our expectations, all the future value, which would be the dividend, the sale price when we eventually sell it, properly discounted. Now, what this seems to imply is that those who can pay for the best information are going to be able to make better pricing models. So you're all working in this class on your Bloomberg project. That's what basically Bloomberg does, is it provides lots and lots and lots of information. If we think of what are the, on TV, what are the stock investor channels? You've got Fox Business, you've got CNBC, and you've got Bloomberg. Well, CNBC and Fox Business, they're not that useful as Bloomberg is, because Bloomberg specializes in collecting information. Whereas CNBC and Fox Business are reflecting different parts of the business. You know, where you bring on the CEO, where you talk about how it's affecting individual households, that kind of thing. Yeah, that all affects stock prices as well. But if we're just concerned about investing when we turn on one of those three channels, my tendency is to go towards watching the Bloomberg channel, because they focus on making me a better informed person and being able to form more rational expectations. Problem with today's market, as my wife asks me about the markets almost every day, is, when she asks me, what do you think? Is it a time to get a client? Is it a good time to get a client back into the markets? And my general sense is no. And that's only because there's just a lot of weird things happening right now. There's just enough weird things happening right now that doesn't make sense to take on that risk. And to the extent then that things are off, my expectations are off, well, then the rate of return based on my expectations would be different than the actual rate of return, which is really how you get investment opportunities. Someone thinks the stock is priced at, let's say, $100. I think it should have $120. Thus, I buy the stock. Now, Bloomberg is one thing. What about all the other stuff? Right? Like, what about a recommendation from, Jim Cramer on CNBC? What about an investment recommendation from Maria Bartiromo on Fox Business? I'm not sure I would trust that as much as something that Brian Wilson, for instance, from Bloomberg could tell me. Or would I trust something that E.A. Buck here on the islands, would I trust something that he tells me? Well, let's look. I'm not disparaging the man. Everyone's got to run a business. But I'm not from here originally. So, I don't know. Isn't that the value of not being from somewhere? Is that you can provide some critique of some kind? Oh, I think that's his daughter, I think. This is not a advertisement for EA Buck. Yeah, it's the... They're married. Yeah, Katie is married to Jeff, and Jeff is the son of the head guy, EA. Let's see, who do I all know here? I do know Nicole. Don't know these people from Colorado. Cherry Creek. There's Jeff. And I know... Sorry, I'm just like... Oh, I know Corinna. She's Canadian. Owns like a farm, something like that. Why am I doing this? Why am I looking at this? Because one thing that they do is they hold workshops, which they say is basically to inform you. I'm not going to click on any of these because I don't want to get a million emails to attend something. But during that, they're going to basically say to you, this is what you should do. This is what you should invest in. That kind of stuff. Because, right, that's how they make their money. In general, the general belief is that if we believe in the efficient market hypothesis, there's no secret information you can get that's going to allow you to make more money than someone else. Which would then mean that the high commissions and whatnot that you pay EA Buck for their opinion isn't any better. Their stock picking isn't any better than just buying something of everything. This slide right here is what leads to the conclusion of how, generally speaking, the advice is that investors should buy index funds rather than actively managed funds. So instead of buying like a mutual fund or an ETF where someone is actively picking what they think are the best stocks, an index fund just buys something of everything and does it obviously at a very low cost because you don't have to spend a lot of money for information because I'm just buying something of everything. And that would at least be affirmed here by the efficient market hypothesis. Again, a recommendation from an advisor isn't going to help us outperform the market. Whatever tip some advisor from EA Buck knows, a whole bunch of other people already know it. So the only thing you can really do is buy something of everything and then hold it over time. Okay. I am a firm believer. You know, when someone asks me how do I invest, I'm a firm believer that market fundamentals matter. Meaning, the market price is important, but there is a great deal of value to measuring cash flows, discounting it, and seeing what the true value of the company should be. Unfortunately, right now, there's not a lot of deals out there. There's just so much cash out there, everyone's been able to deploy it to everything. And so then, the only other way you can really make money, this is how the Reddit people are making money, is by doing something with behavioral finance. Things like YOLO, you only live once, or, to the moon. All these things are based on psychologically trying to make you feel like you're being left out of this great money-making opportunity. And so then you do anything you can to get into it, right? Or this belief that, we are making a whole bunch of money off the very rich. Well, you believe in that cause, and then it'll cause you to buy that thing. What I was trying to say in that investment video is that it's working now, but it may not always work. It shouldn't always work. Okay. This is a rather short lecture, but this now concludes our discussion then of financial markets, and this concludes part 2 of this course.